Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of March 31st. Thank you for joining us. As always, if you enjoy the content and find the information helpful, don't forget to like and subscribe to the channel. Also, don't forget to take a minute to check out some of the other great videos we have here on the JGUA content page. So with that said, as always, my goal for these videos is to use my expertise and background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as usual, we'll start by taking a look back at last week. The beginning of last week looked promising in both markets and trade policy, as there was language coming out of the White House suggesting that the reciprocal tariffs on April 2nd might be a little softer or not as extreme as originally thought. Unfortunately, by the middle of the week, that was all out the window. We saw threats against Canada and the European Union, if they were to ally and work against the US, that the Trump administration would dramatically increase their tariffs. We also saw a brand new 25% tariff on any imported vehicles, which included and includes domestic vehicles assembled outside the United States and imported for sale to US customers. As a result, we saw auto manufacturers, including Ford and General Motors, as well as car parts manufacturers, take a big hit in their stock prices throughout the week. On the inflation front, last week we saw the Personal Consumption Expenditures Price Index. We saw mixed results out of the report, as the headline number showed a steady 2.5% increase in prices, while the core number jumped by an unexpectedly large amount to 2.8%, significantly surpassing the expectations of most analysts. On a positive note, we saw consumer spending from January to February increase by about $90 billion, which was a bit reassuring, given that in January we saw a big drop in consumer spending, and there were concerns that that might be heralding the next recession. Unfortunately, in stark contrast to the consumer spending data we saw consumer confidence and consumer sentiment reports both released last week, and both showed dramatically increasing pessimism for the future and growing concerns for the current economic situation and the potential for increased unemployment and increased inflation. In fact, the Consumer Confidence Expectations Index dropped to the lowest level it's been at in 12 years. It also dropped below the threshold where we normally consider indicating a future recession on the way, and it dropped for the fourth consecutive month in a row. We also saw consumer sentiment towards the end of the week drop for the third straight month in a row. This index has dropped 12% since February. It's dropped 30% since November. And we have seen widespread, broad pessimism taking hold of the consumer sentiment survey. We've seen sentiment decrease for all political affiliations, all income groups, and all demographic groups. We've seen consumer sentiment towards personal finances, business conditions, unemployment, and inflation all worsen by a dramatic amount. 2/3 of survey respondents answered that they expect unemployment to increase over the next 12 months, which was the largest proportion since 2009. And we saw inflation expectations balloon even further. Short-term 12-month inflation expectations jumped from 4.3 to 5%, and long-run inflation expectations increased from 3.5 to 4.1%. In spite of all the growing concern in consumer confidence and consumer sentiment, we saw a further indication that one group is still doing exceptionally well, and that would be corporate profits. We saw the final revision for fourth quarter gross domestic product, which always includes a corporate profits report. And we saw that in the fourth quarter of 2025, corporate profits increased by $200 billion, in contrast to a $15 billion loss in quarter three. And we saw that corporate profits throughout 2024 were significantly greater than they were in 2023. So at least one group seems to be doing well. The big question is whether that will continue into 2025. Unfortunately for all of us, the future isn't looking terribly bright, at least according to the GDP Now tool hosted by the Federal Reserve Bank of Atlanta. The GDP Now tool essentially collects all the available data and information that will most likely feed into the gross domestic product measurement and gives us a nowcast of what the data is telling us. Unfortunately, the most recent update at the end of last week indicated that GDP growth for Q1 2025 may be as bad as negative 2.8%, which is actually tied with the lowest estimate that we've had so far for this upcoming quarter. All of this put together suggests that there are definitely reasons to be concerned. There are things that we need to continue to monitor, and that it's incredibly important that you pay attention to the news and to these weekly market updates so you can stay informed on unemployment, inflation, and GDP, as well as what's going on in the markets. Speaking of which, let's switch over to the stock markets. According to reporting by FactSet, stock analysts currently seem the most optimistic when looking at Q2 2025 surrounding the energy, information technology, and communication services sectors. Stock analysts seem the most pessimistic around the utility sector and seem the most hesitant or undecided when it comes to the consumer staples sector. We've also seen that the materials sector has taken the largest hits to Q2 2025 earnings per share estimates. Switching our focus to the major stock indices, last week was just an absolutely brutal week for stocks. The beginning of the week seemed optimistic. There were several days of gains back to back. But unfortunately, by the middle of the week, concern about tariffs had returned, and the inflation and consumer sentiment data on Friday drove an absolutely massive market sell-off. The NASDAQ led all three indices with the greatest losses, followed by the S&P 500, dropping about 2% just on Friday, and the Dow Jones Industrial Average. Taking a look at the yield on the 10-year Treasury, we saw the yield increase early in the week from about 4.25% to about 4.4%, but as with the stock markets, ultimately fall back down to about where it started, ending the week somewhere around 4.25%. Bitcoin and the crypto markets also followed a similar pattern. Bitcoin grew early in the week, reaching as high as 88,000 per coin, but ultimately by the end of Friday had fallen back down, at one point crossing below 84,000. The price of crude oil rose throughout the week, although we saw a slight dip on Friday as concerns about inflation and geopolitical tensions returned. We also saw the value of the dollar fluctuate throughout the week, but ultimately end up just slightly higher from where it started. And last but not least, the market for gold absolutely took off. The price of gold increased throughout the week from about $3,040 to about $3,125, which was a significant jump, and just another indication that investors in a lot of ways are looking for increased safety, and gold, being a traditional safe haven, benefited from those cash flows. Well, swinging our attention to this week, the two big stories this week are going to be jobs and tariffs. April 2nd is a huge day for tariffs, as we see a variety of tariffs taking place. Specifically, we see reciprocal tariffs against our trade partners. We see the resumption of tariffs with Canada and Mexico. We may see potential tariffs with the European Union as have been threatened. We may also see targeted tariffs on industries such as copper, lumber, and pharmaceuticals. We may also see secondary tariffs on countries that do business with Venezuela. In addition to that, we could, of course, see tariffs on anything at any point, anything that pops up between now and then. Semiconductors and chips have been on the table, but haven't explicitly been mentioned recently. The second piece of our main headline this week is jobs. It's the first week in April, so we'll be seeing the job openings and labor turnover survey for February. We'll also be seeing the ADP private employment report and the national unemployment report for March. The reason jobs are significant this week, aside from the fact that unemployment is a growing concern, is the fact that these reports may be the first to show indications and to capture the changes that are taking place as a result of cuts in government spending, and specifically the actions of the Department of Government Efficiency. Even though all the attention this week is going to be on the jobs numbers, we'll see some other important economic data being released, specifically construction spending, factory orders, the Institute of Supply Management's reports on the service and the manufacturing sector, and the latest data on the trade balance. I want to take a minute to encourage all of you to reach out to family and friends, reach out to your community, and do what you can to help calm nerves and reassure folks. Even though there are some concerning signs in the economic data, and there's clearly a lot of concern around the way people feel and fear about the future, it's important that we use this time to come together, support each other, and look for trusted, reliable sources for information that aren't just looking for headlines or clicks or engagement. With that in mind, I want to encourage you to come back and join us here next week. As usual, we're going to do our best to read through all the economic reports, study the data that's being released, understand the analysis, and bring you the information you need to stay informed in a helpful and unbiased way. We're going to do our best to use what we have at our disposal to keep you up to speed on the markets. So with that said, good luck, have a great week, and we'll see you in next week's video.